Hello and welcome to the CNBC Africa special. I'm Nozipho Mbanjwa. We're coming to you from Washington, D.C. at the IMF World Bank Group annual meeting. We'll recall that just last month, the world had gathered to celebrate the first anniversary of the Sustainable Development Goals. And perhaps one of the key reflections that have come out of that UN gathering was the grave acknowledgement that unless we significantly begin to mobilize commercial capital at scale, that the Sustainable Development Goals would remain just that, goals. And so today's conversation will begin to explore increasingly innovative and new financing approaches that may help to unlock, to scale, to mobilize and redirect trillions of dollars for a shared prosperity. Ladies and gentlemen, the panelists joining us for this conversation will be bringing their insights, their experiences, and their voices to this conversation. It gives me great pleasure to introduce the Executive Vice President and the Chief Executive Officer of the IFC, Mr. Philippe Leweru, as well as Dr. Andreas Gruber. He's a Chief Investment Officer at Allianz. We are also, ladies and gentlemen, joined by Emmanuel nasse-bridier. She is Group Chief Credit Officer at AXA. Ladies and gentlemen, Thomas Konditi joins us. He is the Vice President looking after the Africa Transport Portfolio at GE. And next to Thomas, we are joined by Teresa Barger. She is the CEO and the CIO of Kotika Management. And last but certainly not least, ladies and gentlemen, we are joined by Afsena Bleshlos. She is founder and CEO of Rock Creek. Welcome to all the panelists. Now, ladies and gentlemen, what I've invited the panelists to do is to give us a very brief opening statement of no more than 2 minutes to share with us what they think is going to move the world and move commercial capital increasingly into challenging and riskier environments, but at a large scale and significantly unlocking and crowding in commercial capital. The big question is, what needs to change for us to move from billions to trillions? And Philippe, I start off with you and give you 2 minutes to give us your big ideas.
Well, I just left my speech because it's not 2 minutes, so I'm going to make it up then. I mean, first of all, as it was introduced by Gavin, this is a key issue, and one of the key issues that will be discussed during this annual meeting. How do we scale up? How we go from billion to trillion of development finance? Now, that is based on the very logical conclusion that ODA will not do it by itself. The gap between the ODA, which is 160 billion a year, and the trillions needed a year only in infrastructure is just too enormous. So there's a mathematical issue right there. So how do you bridge that gap? Now, obviously, everybody goes where the money is, and the money is in the banks. The money is in the pension funds. The money is in insurance companies. And we believe that there is a match that makes sense between the returns and the yield needed for these institutional financiers and the needs. Now, the matchmaking, how do you do this matchmaking? That's the key question. So we need to have the returns and risk-adjusted returns and to meet this match. So the role of IFC, we have been in the business for 60 years. In fact, it's our 60 years anniversary. We have had a lot of experience. We transformed 2.5 billion of paid-in capital into about 250 billion over the years of investment in emerging markets. We have learned a lot on the way, and we believe that we can play this matchmaking role. But for that, we need to shift the way we do business. It's not only about leveraging others, and we have been quite successful, and we can be even more successful. But it's also to create a pipeline of projects. But to create a pipeline of projects, you have also to be, especially in more difficult geographies, and in the jargon we call it IDA countries, how to create markets, not only seize opportunities, but create them. This is a different order. And we believe we have a comparative advantage because of these 60 years, but also because we're part of the Bretton Woods family. And we have our colleagues in the World Bank that can help work with the public sector. You need the regulations. You need the enabling environment to find this pipeline of bankable projects. So that's part of the equation. You have two parts of this equation. You have the finance, and we can discuss, but you have also creating the space for private sector solutions to infrastructure, for example. So this is what we are embarked to do. We call it IFC 3.0. That's a new strategy. And we are basically getting ready to do it because we absolutely agree with both what was discussed at the UN, but also what Gavin said. How do you make it happen in real life, and how do you muster the power of and the flexibility, the agility, and the source of capital of the private sector to actually make it a reality?
Right. So I don't doubt that we'll be able to learn, Philippe, what makes 3.0 different from 2.0 and what the IFC is going to be doing differently if we're talking about scale. But let me get to Andreas, because Andreas, you've got a tough task here. Matchmaking has been taken, shifting the way we do business has been taken, the creation of new markets, another idea that we haven't perhaps really engaged with, has also been put on the table. From the Alliance perspective, what do we do differently?
You know, there's a lot of capital out there. We have $700 billion to invest. We are looking for investment opportunities, but we are also a bit afraid of investing in emerging markets and especially in infrastructure products there. Why is this the case? You have to understand the reasoning for the past to change the future. Firstly, the regulatory environment is extremely complex. You have to be on the ground to understand the specific regulatory environment in the single countries. And this is not necessarily stable. This might change quite quickly. Secondly, not all the investments work out positively. So there might be defaults, and a default is not bad per se, but you have to have a proper workout process to manage the default, to get some of your money back at least. Yeah? And these workout processes usually do not have a stable environment today in emerging markets. So it's also about trust in the legal environment, in the regulatory environment, in the workout processes. Why is this so important for us? You know, we do not invest our own money. We invest the money of our clients, which is the old age provision of the man and the woman on the street. So we need to deliver them a monthly stable pension. So we need stable returns. And although the yield environment today is extremely low, we cannot just increase the risk to go for higher yield. We have to find a kind of stable, trustful environment. And I think with a partner like IFC, maybe we come later back to this one, we are able to combine investment needs and the necessary stability for us.
Thank you, Andreas. So a very big focus on how do we de-risk the environment, in particular looking at the regulatory environment and how do we do business in a way that allows for maybe more certainty in regulatory space, so that long-term insurers could actually come in and unlock some of that long-term capital that we're looking for. Emmanuel, allow me to give you an opportunity to put the burning issues on the table that you think are going to move us forward.
Yes, thank you. So I think what is important to notice is that we are an insurance company, Allianz and AXA, so which means that the core of our business is to provide protection to our clients. So as a result, as you said, we have significant amount to invest on behalf of our clients. So as far as emerging market is concerned, it's pretty clear in our strategy that this is the way we want to develop ourselves in this new market. But for that, we need to be extremely clear and to do some homework. We need to know what we want to do, where we want to do it, how we want to do it, and with whom. And I think this is all these challenges that you need to be clear in-house before going to that market. And then you can try to find some solution, but you have to test some ideas on the insurance side, on the investment side, is what we do with MCPP and Infra, but also to know your strengths and to build up some partnership with key players. Because it's impossible for a global company like AXA to have an in-depth knowledge on all individual sub-market regulation and so on. So we have the opportunity to leverage the know-how of the others, and we to try to find an alignment of interest in terms of economics, because this is what matters in order to share risk. Because as Andrea said, we cannot take risk on behalf of our policyholders that we do not understand or that we do not control. So all together, we need to find a way to have this confidence, to have this knowledge, to deploy our capacity, and again, to deploy our footprint in the insurance business. If we invest in developing market, this is not only for our mature balance sheet, but this is also to enable developing market to have access to much more insurance product, and that will lead us to do billion to trillion.
Fantastic, and I think that links quite nicely to the statements that both Andreas and Philippe have made, because you've started off by telling us that insurance players want to be in emerging markets, so that takes care a little bit of the matchmaking. We know that there is a desire to work together, but I want to make sure that we don't lose some of the salient points you've raised. You've highlighted partnerships, which I think speaks to the issue that Andreas raised as a red flag, to say it's difficult when you can't be on the ground, and perhaps partnerships perhaps help to begin to de-risk in that environment. But I also want us to make sure that we don't lose the point you've made around better risk allocation as a way of moving forward. So we'll come back and we'll begin to digest some of those points. Thomas, again, it would be great to understand what you think needs to be put on the table, and also what the experience of GE has been.
Thanks a lot. So first of all, we have, and I'll be coming from the perspective of Africa, because I run a business that really covers the majority of Africa. By definition, going from billions to trillions means that you have to be 1,000 times better at what you're doing. So we really can't look at incrementalism in addressing the question. We are in multiple sectors, whether it's oil and gas, power, healthcare, aviation. So we see a lot of the need side of things, and then we see this gap between here's the need, and here's what I can do to pull it together. I think two big things. One is, how do you catalyze good projects? Because you just heard that there's $700 million of capital sitting there trying to find a good home, but you'll always hear there aren't great projects out there. So I think anything that focuses on good projects, innovation, de-risking them, and addressing some of those structural gaps is going to make a difference. Things like innovation, I'll bring up a project we've done in Kenya, which was to take healthcare, a tough space. You still need expensive technology if you're going to make a difference in neurology or cancer or even infant mortality. Well, that costs money. You can try to buy everything, or you can do something innovative like take a full service lease that gives you 7 years worth of service in 100 hospitals, make the scale big enough for a company like GE for big money to go after, and voila, in 14 months, you have something that people have not been able to do in 30 years. So you have to think innovative, and I think the capital has to support that. Structural gaps. We talk about power. Most of your power utilities are insolvent in places like Africa. So when you start looking at your risk management, you start saying, well, I can't lend to this utility because they're insolvent. We have to do something 1,000 times different to block that. So that's where I see maybe a shift from direct lending into things more like credit guarantees and guaranteeing the environment as opposed to just putting money into it. That de-risks for maybe more risk-averse funds or other people's money to go into places that need development. I think the other thing is, there's some crazy stuff out there. Every PPA for power is unique. It's like a child, and nobody ever wants to give up their child. We have to have a standard child. We have to have a child, a PPA that I can smack into Malawi, South Africa, Kenya, Indonesia, and you change 1 or 2 lines to be figurative, and there you go. I don't need a year to negotiate, I need a week. And I think finally, and this is going to be a little controversial, we've gone to trade, not aid. Well, I'm going to say, why don't I take my aid and focus that on investment versus social? Now, I'm going to get a lot of people, especially NGOs, who will hate me for saying that, but leveraging a little bit of aid as a credit backstop to an investment project gets a lot going out there versus you can feed 1,000 people, but I can light 1 million people with a little bit of the same money.
So lots of controversy. I'm not sure about standard children, but we'll work on that one. Again, we'll come back to that concept because what we often hear, Thomas, is that African markets are so unique and so dynamic and are not like any other market. And so you often are told, or the general analogy is that what you can do in South Africa, you can't always do in Nigeria. So we'll test and we'll challenge some of the things that you've put on the table. And perhaps one of the other salient points you've raised is around innovations. If we're saying that we're looking at innovative projects, we need innovative finance. So what does doing things 1,000 times better actually look like? So we'll get into the nuts and bolts of that. Teresa, I'm keen to hear what you're going to be putting on the table.
Thank you, Nozi. Just for introduction, I have a private equity background, but currently invest in listed equities, so yeah, I'll have that lens. I assumed when I was asked to be on this panel that others would have already covered the very basic issues of rule of law, access to foreign currency, access to tenor loans, or loans at a tenor, currency depreciation, stable policy, et cetera. So I just wanted to focus on some very three specific findings on how to invest and allocate capital. One, in emerging markets, country selection is the most important element in achieving outperformance in investment. A new study in the Journal of Investing indicates that for investments in listed companies, close to 80% of outperformance is due to country selection versus 44% for developed countries. The World Bank and IFC often don't have the luxury of choosing countries because of their mandate, but the private sector does have this luxury, and I might say this imperative to get the best possible returns for their pensioners, their policyholders, and other beneficiaries. IFC's own data backs this up and 14 other studies on the importance of country selection for equity investment, and also specifically cites that the way that investors make more money is by investing in countries which are in the process of lowering their own risk profile, or to put another way, where CDS spreads are about to fall. Second, in the last 10 years, we've seen that returns vary enormously by the type of company that you have. Specifically, in the emerging markets, most companies are controlled. And in fact, most countries in the entire world are controlled by a family or a guy who founded the company. That's what most companies are. But that's even true in the listed world. So in the emerging markets, only 15% of companies listed are widely held by lots of shareholders, and those are mostly in South Africa. Research shows that over the last 10 years, founder-controlled companies, controlled by the guy who founded it, give you 150% return. Family-owned companies give you 120% return. Widely held companies, not so great, 48% return over that 10-year company. And state-owned enterprise gave you, let me look at my notes here. Zero to return. It is almost a rule of thumb that one can improve returns by simply not investing in state-owned enterprises. These companies rarely have maximization of shareholder returns as their main objective function. And three, traditionally, investors require higher returns from emerging markets to cover the risks entailed in messier politics, worse economic policy making, worse rule of law, less developed institutions. What's fascinating today is that we are seeing the risk premium to invest in emerging markets over developed markets diminishing. This is in part because many emerging markets, not all, but many have been reforming and are more stable and have less debt. Sadly, another reason for the diminution of the risk premium is that the developed markets are kind of a mess. We have seen risky situations. Surprise Brexit, the Donald Trump wild card, fascist-leaning governments in Poland and Hungary and maybe Austria, the Deutsche Bank crisis, the financial and political crisis in Italy, and a policy-weary Japan. So I would posit that we just might be at an inflection point where EMs are looking a little bit more like a shining city on a hill, and the developed markets are looking more like a favela
Fantastic! What a lovely analogy, Teresa. I think we're going to come back to the point that you raised about state-owned enterprises. I think that's exceptionally important in light of the fact that we always see these as the ideal vehicle to drive development. So if we're saying that returns are 0%, there's a conversation to be had around that. But let's move on, and let me now get to Afsana. Afsana, again, an opportunity for you to paint the canvas on what do you think needs to happen?
We're talking about going from billions to trillions. As Gavin said, we've got 140-some billions when you look at the multilateral institutions. When you look at pension funds globally, there's more than 35 trillion of assets sitting in global pension plans. There's another 7 to 10 trillion, depending on how you count them, among the sovereign wealth funds. There is a lot of money, as you know, in the retail markets, and then, of course, insurance, where we have been talking about, and many other markets. So the size of the markets to be tapped are huge. The other thing we should remember is that the growth factor in emerging markets, despite everything negative that we read, is still double the growth of developed countries. So number one, for an investor looking in really at global opportunities, the fact that emerging markets will, in the next 5 to 10 years, be growing double the rate of developed markets is a really important factor. The next level of important factors is that what we talked about, the issue of scale, the issue of sophistication, etc. I would posit, though, the largest part of the investments globally, again, are public equity markets. More than 45% of global investments are in public markets. Then you've got another 6, 7%, depending on how you count it, again, in bond markets. The rest is in private equity, real estate, venture, so on and so forth. So it's really important to be able to invest across all of these. But how can you invest in private companies if you don't have a good public market for your equities? And why do I stress that? And I think really important as a role for IFC also is that if you want to invest in India very specifically, let's say you are the pension fund of the state of New York or your sovereign fund. If you invest in China, you do not pay any taxes as an institutional investor. If you invest in India, you do have issues of local taxation to deal with, which, as if you are a retail investor. That's a huge problem in India that needs to be tackled. And in order to bypass that, you have to create a company in Mauritius or things like that, which does not make the market very efficient. 40 countries in the world, and among the emerging markets, don't have any exchanges at all. Well, if you don't have an exchange, how are you going to develop your markets? And again, another very big role for the IFC and multilaterals to pay taxes, exchanges, very simple things. Derivatives. If you're an international investor, when you invest in a country, you want sometimes to have your currency not get devalued. If you're investing in local markets, which is really the way to invest in emerging markets, go find the best local people who know the specific situation in those countries. So again, you need very good derivative markets. So you don't have to get super sophisticated, but some of the tools that are out there in basic markets are ones that we could benefit from. And I think the last thing I just want to mention, because you started with the issue of SDGs, and Gavin mentioned the issue of SDGs, there are a lot of SDGs, but some of them are much more measurable. And I think I would look at those. It's not that all of them are not critical, they are. But in order to generate capital from the private sector, which is more looking at results and returns, let's take the health sector. Health sector in emerging markets is 1% of the total emerging markets, but also the fastest growing area, as we just heard. So that is an area which will help the SDGs in terms of the well-being of the population, but also very importantly is one of the highest sources of returns in the world.
Fantastic insights, and I think definitely you're going to have to lead the conversation to talk about how to improve the depth and breadth of these public markets. But I think what you've also raised, Afsana, which is quite important, is starting small with the view of building up to scale. And what I'm almost hearing is a suggestion is that we start with what's measurable. The big question then is what's measurable the most impactful? And we'll come back to have a conversation around that. But Philippe, I want to come back, understanding that, again, there has been a significant launching of an innovative financial approach by the IFC just today. We're talking about the MCPP infra. And perhaps what you could do very briefly, Philippe, is in the context of this conversation, I don't think the timing is a coincidence. How does this change the game for IFC, and how does it fit into IFC 3.0?
Well, it's part of the equation of the 3.0, but let me explain. The idea of MCPP is basically to kind of syndicate and leverage other source of finance in addition to what IFC invests directly. So that's a syndication mechanism, but it's something that will be automatic. So what you de facto offer is a diversification of throughout the emerging markets of all the projects from Africa to East Asia, Latin America, Eastern Europe. You have a built-in diversification by buying a share, if you want, of the syndication throughout this project. So it's a portfolio approach. Mm-hmm. One of the P of PP is portfolio. And that's very important because de facto you built in this diversification, which in itself is a risk mitigation, built-in risk mitigation. So why we are so proud? I mean, the program started, in fact, thanks to the, talking about the SOE, thanks to the Central Bank of China, who started with us to have this kind of what I call blind syndication, but diversified. Mm. And now we just signed with Allianz, and we hope that other insurers will join very quickly for them to contribute in this fund, which again is an automatic syndication fund. And the key here is basically to start creating with the private sector, which is very important. The private sector comes in this fund, this is the first time, so they are the first movers. We hope that will be replicated by others, but it's, for us, we believe it will be an historic moment if it works, because de facto we will create an asset class. We've been talking about infrastructure asset class around the world, a little bit kind of older child, etc. So the problem is we're looking for scalability, and you're absolutely right, which means harmonization. Mm-hmm. So we are working, and if this works, I mean, I think that we will start de facto talking about a new infrastructure asset class for emerging markets. And this is, we believe, an historic moment. We'll see, jury will be out. We are very optimistic, and we believe that in the years to come, we'll see more and more coming on this platform, which is a very effective platform. So that's the MCPP program. We're very excited, to be honest. It's because this is our one stone in the billion to trillion, and a very practical one.
Right, and it's one stone of many, and I'll come back to the other offerings. But Andreas, we hear Philippe saying that hopefully it works, and hopefully we would see the emergence of a new infrastructure asset class. You seem to have more than hope because you've unlocked a significant amount of investment behind this. What's made the risk more palatable for a player like Allianz?
I'm very happy to say that we just signed the contract, so we hope it works, but we are also convinced that it will work. Let me come back to your question to Teresa, yes. Because I do not fully agree what you said. When we invest in public investments like equity, we always look at the benchmark and we want to outperform the benchmark. I think if we look on private investments, on emerging market investments, on alternative investment, this is the wrong view. We have to think as an absolute return investor. We have absolute liabilities. We want to give our clients a 4% yield on a very safe basis. We are absolute return investor, and we have to translate this also in our assets. So we have an absolute return level, we have an absolute risk level we would like to take. And now I come back to you. Why is this collaboration with IFC so great? Probably the return is a little bit lower than for other emerging market investments. But it's not bad, because the risk is much lower, we hope, for 3 reasons. The first one is you really know the emerging markets. You are on the ground. We are in many countries with Allianz, but not in every single country in Africa, for example. So here we can use your experience, and your track record in the past showed this, that you really have this experience and worked it out in your portfolios. Second one is, yes, it's also the World Bank behind you. You know, it's a special creditor status you have as IFC. Hopefully Allianz has also a name, but we don't have your name. We don't have your special creditor status. And to change the regulatory environment for investments you do, and we only cooperate in these investments, you do, is another step really local governments have to think about. Yeah. And the third one is a first loss piece. You provided us with a first loss piece so that we can adjust the emerging market returns, which obviously even step 1 and 2 are more volatile than government bonds in Germany, where you can for sure get a safe yield of 0%. It enables us to reduce the volatility a little bit to our needs for our old age provision clients.
Fantastic. And I think I know, Emmanuel, that you're listening to these tick boxes. So it's a lower yield, but it's a fantastic credit status. Lower yield, but over the long term, still attractive.
And higher than in developed markets.
And higher than the developed markets. So you're possibly also looking and thinking, should the courtship move a step further? Is this a place that you would be playing in? But I want you to think about that. But what I wanted to do is also come back to some of the earlier comments that you've made. And I want to tap back into the comment you made around allocating of risk. I mean, risk allocation has always been, for example, standard operating procedure in project finance, in public-private partnerships. I'm not convinced that we've begun to have a conversation about how do we allocate risk differently and how do we think about risk differently. What would you present or maybe put forward as the way that we need to maybe rethink and review risk so that we really can start thinking about scale?
I think I fully share what Andreas said regarding the way we can handle the risk profile of the emerging market with the protection provided by IFC, and we follow this initiative, and we will be there soon. I think on the other aspect, and to take some practical example of what can be done to leverage again some example with IFC to try to diversify the risk profile and to make it happen. I think it's what you said, we cannot be everywhere. We need to focus and to be selective on the country we want to develop our business. And we need to be also extremely clear on the segment of the market we would like to focus on. And another example I would like to take, which is a little bit not on the investment side, but which is on the insurance side. It's a tremendous work that we did with IFC to try to identify the potential of the emerging market insurance product for women. So this is the She4 Shield report and how to protect women, to protect all. And I think for us, it was a trillion market, the protection to provide to women, including in the 10 emerging countries that we have identified, is a trillion market, which means that by being focused, by knowing exactly what we want to do, we are able to be impactful. This is what we are doing today with IFC. We have 2 pilots, one in Nigeria, one in India, where we try to see with one specific segment, which is the woman entrepreneur, how we can provide some guarantees, how we can put some services together to try to provide protection for the way these women are quite impactful in supporting their family and the community. This is typical example of how to allocate risk differently, how to leverage on the new technologies. You know that this is a key advantage that we have today. We can distribute our product differently thanks to the new technology. So which means that diversification in terms of risk, but also in terms of organization and assessment of the market. So to do it step by step, but with really practical example, allocation of the risk means a clear understanding of the local risk you are ready to take.
So I see that, Afsana, you've got a comment, and I expected that, and perhaps I'd like you to respond, but as you do, maybe also respond to the question that I was going to throw to you on the back of Emmanuel's insights. You spoke earlier on about focusing on that is measurable, perhaps as a starting point. And what I've heard Emmanuel almost say in one sentence, measurable and impactful together. What are those special sectors where we can quantify the impact that commercial capital can have and still hit the target of impact?
Thank you. So first point on, you asked about risk. The way in public markets you measure risk is volatility. Obviously in emerging markets, highest volatility compared to total equity markets. That's just part of the market. In bond markets, it's come down somewhat, but still a little bit higher. So this is a really big issue because what is very important when you invest in emerging markets is to have a long-term perspective, what we just talked about, which is why some of the tools you just created in IFC and looking at infrastructure, which is a long-term investment, is really key. But at the same time, really the job of all of us who are interested in the development of emerging markets is how do we make sure investors know that, in fact, the returns are very high, but you have to look at it longer term. So if you look at emerging market 20-year return, 10-plus year returns, they are the highest of any other asset class. If you look at it just for a year or two, it's either the highest or the lowest. So this issue of volatility that you touched upon, I think, is really key. Jumping to the question that you posed, there are certain things like we discussed, power, pharmaceuticals, transport, energy efficiency. They all lend themselves very well to measurable standards. So for example, we've invested at my firm at Rock Creek in Sub-Saharan Africa, and we will find opportunities where you look at the consumer lending operation that is lending specifically for you to transfer to solar power. And in fact, that has made a lot of money. We've invested in energy efficiency with a 6 times return. So basically, in a lot of the areas where you can invest in emerging markets, in certain sectors across the board, you can make money. But one thing that we did not discuss, and I think is a huge source, and will become an even more important source of funds for emerging markets, is the whole fintech area. There is 2 things happening, particularly in the developed world, but really globally. The young millennials want to be impactful and have returns, going back to the point you raised. And if we could create tools for them through IFC, through the World Bank, through the multilaterals, where there are new instruments, new ways of getting, knowing all the very interesting projects that are getting done here, so that the people who have money, who want to be impactful and have some return, can find where they can actually invest. That's missing right now. And there's also the much bigger population where pension funds, and now with robo-investing and with fintech again, where IFC and bank could really play a very critical leadership role.
Fantastic, and it would be interesting to see how many of these comments might begin to mold and shape 3.0 as it begins to cement. Teresa, I want to come back to you. I want to give you an opportunity to respond if you'd like to Andreas, but also we're still on the theme of risk. And one of the things you said very early on is that maybe there is a need to focus on the basics. We still probably need to think about the prevalence of rule of law. We probably still need to think about access to foreign currency in some of the markets. So as you weigh in on the risk, perhaps also maybe give us a sense of how do we get those basics right? It's been far too long where there are still certain fragile and conflict-affected markets where those basics are not in place, and we run the risk of completely leaving them out of this conversation and of the movement of moving from billions to trillions. How do we make sure that doesn't happen?
Thank you. I would say to Andreas, of course I agree with you. You can't eat relative returns. You can only eat absolute returns. But in terms of making a academically sound study, you have to have something to measure things by, which is why you look at relative. But the IFC study of its own equity returns, you start with absolute returns. The absolute returns are much better in countries which are reforming. They're much better absolute returns. So either way you look at it, you come down as a measurement tool to look at relative, but it all starts with absolute. So I don't think we disagree. Absolute returns are what everybody wants. I'm glad thank you for asking me that question. I'm a little uncomfortable with, when Michael says we've got to be 1,000 times better, oh God, how's that going to happen? I've got to go to the gym 1,000 times more. I've been in this business a long time, and it's tough getting those basics in. So when I started at IFC during the time of the War of the Roses or the Peloponnesian Wars sometime back then, one of the big issues in the financial sector was there was no term finance, that you could get long-term finance was 3 months, 6 months, 9 months, and now I look in the emerging markets, what's the big issue in the financial sector? You don't have long-term lending in local currency. I'm like, oh crap. I worked my whole life on this one issue, and where are we? So we've got to get that issue. You've got to get local currency financing at longer tenors. So what I did, my last project at the World Bank Group was to work on bond markets, right? So let's work on bond markets. We were trying to set up indices for bond markets, country by country, so that then retail investors could invest in index funds, and you could mobilize money into bond markets. We've got to get longer funding. Those things, unfortunately, each country has a financial sector that's ring-fenced by its own regulatory environment. Not true when you get to fintech, where you want to compete globally, but you still got to have those local rules. The other thing is, the most basic thing. No rules yet. That's always good. If you're in India, go into an area that has no rules. Like that's why leasing was successful. It's because there were no rules. But the most basic, how to start a business, business creation. I personally think the World Bank has done the biggest favor to the rest of the world in all of its history through the doing business studies. It only measures 12 things, and it's only it is only an indicator of those things. And of course, there are many, many other areas that you can eliminate red tape. But for goodness sake, don't have 17 steps to set up a new business. 2 or 3 will do. Right. And let people set up a new business.
Thomas, looking at the practicality and maybe using the power example, how would that work in an African context where the markets are just so diverse?
Norzy, we are in a far worse position today than we were 5 years ago in Africa. The story 5 years ago was Africa rising. Most of us know about that. The GDP growth of Africa this year is going to be 1.4%. The population growth is 2.7%. Bad news in a per capita income. And it's not, commodity pricing is not coming back tomorrow. It may not come back for 5 years. Yet I'm still adding a few million people a week or a month. So we're in a bad place. And I mean that when I talk about the 1,000 times difference, it's we have a potential catastrophe. If we don't think of how do I get power, healthcare, some of the basics out to these millions of people that are coming online every year. So going back to, that should be an impetus for speed.
Right.
PPAs, negotiations, financing takes years, years. But when you look at what comes out the other end, it's a gas turbine, a gas pipe, a generator, and a transformer, and boom, I have power. This is not very complex technology, but we take years to get there. So the standardization of some of our structures for getting the project going is why you need to standardize. I need the standard child because I can't afford to be unique for everybody. Now I have 4 kids, so I love all of them differently, but I love them a lot. But it would be easier if they were all the same age, wore the same clothes.
Yeah.
And changed their own, and ate the same food. But my point is, the standard PPA harmonization makes things easier, faster, it de-risks.
Some people don't invest in Africa. Again, that is actually an issue of scale. In Africa, there are only 2 countries that are qualified as emerging markets, and that's Egypt and South Africa. And then within the frontier market index, you only add Morocco, which was demoted from emerging markets, Nigeria, Kenya, and Mauritius. So in the frontier market index, you don't even have Ghana or Botswana or the Zambian Stock Exchange I set up in the 1990s, or Namibia, or other very low liquidity markets. So when CalPERS says we don't invest in Africa, they only really have three choices: African debt, which they probably do invest in through some of their managers; private equity, which again isn't enough of a scale, but there could be a scale. They're bite size. They like to invest $300–400 million at a chunk, so that's tough for them. And in listed markets, it's almost impossible. They're just too small. So it doesn't mean that you can't tap into those through fund managers that are maybe global, which a bit of their money is going to Africa.
How do we ensure that when we're thinking about protecting against interest rate fluctuations, we're not only focusing on the lender or on the lender, and that the borrower is also a consideration in the conversation? And do you think that this is going to move us towards scale?
Great points. I think just a minor point on the exchanges, I think scale does matter, and especially today we're in a different place than we were a while back. So, when we buy in Africa, sometimes you cannot sell for like months. So if you are buying in public markets in Africa, it's as if you're making a private equity investment. So having exchanges that are more regional and can be, servicing several countries, I think will be very helpful and cost effective. In terms of the other thing worth mentioning on CalPERS or others not being interested, I would say when we started our Africa Fund, there was so much interest we could not take all the capital. So there are different ways of looking at this, and I think the reason is that particularly in this country, the group of people who are most interested in Africa were endowment and foundations, some of the most sophisticated. And they do have a long-term view, and they are looking at high returns. They were not looking at it as just an impact investing. They were looking at the financial returns. But they know that they're doing this for 10 years. It's not a public investment. So in that sense, I think there are investors who are interested. And I think what we just talked about, it would be really wonderful if there was an IFC site. And if I'm interested in education, I would just go and see where I can make my little investments. And if I'm interested in power, how do I do that? In terms of sort of the point, in terms of fluctuations, basically we're talking about currency swaps. I think interest rate swaps, the other area where we did not really touch on, but that could also be an area where the multilaterals and the treasuries and the multilaterals would be very, and Yingdong hopefully will talk about some of this at the end, will be very critical to create the tools to deal with the interest rate fluctuations that are happening in these countries.
Emmanuel, let's give you an opportunity just to weigh in as well. Yeah,
just a couple of comments. I would say that we have a unique opportunity today to try to have much more investment done in these countries, because on the other rest, as we explained, we have not a lot of opportunities and low yield. So you will find a lot of people trying to chase for yield and looking at new opportunity, which is a huge responsibility for people like us, because we need to be crystal clear of the risk profile of what we are doing. Because if we have a significant bad news or issue, then you can be sure that you will never see new investors coming to Africa, for instance. There's different way to do it. So with Allianz and AXA, we are big enough to have some in-house knowledge on how to do it, but we work with IFC. You have any type of third-party asset manager which can leverage their expertise, gather the asset, and also provide this type of expertise to, I would say, investors who have not this type of resource available. But again, we need to be extremely clear about the risk profile, the fact that there is no liquidity, the fact that we are looking for long-term investment, and it's not an issue. And the good news for us, for instance, in terms of interest rate, is that what we'd like is fixed rate asset. we are desperate to find fixed rate assets. So on the other side, that can be an issue to swap from floater to fixed. But on our side, as a long-term investors, we like for duration management purpose to have fixed rate. Having said that, that doesn't solve all the issue. IFC and the MCPP program is in hard currency because we cannot have local currency. We want to invest in dollars or in euro, but it's floating rate. We will like to have fixed rate. So we cannot find solution on all the aspects, but I think this is a unique opportunity for us to start. And then if we are able to see that works, you will see a lot of people following, and it's a good news.
Let me explain the difference between risk and uncertainty. We talked a lot about risk, but we did not talk about uncertainty. And there's a precise difference and a precise definition. You talk about risk if you do not know the outcome, but you have probabilities for the possible outcome. Mm-hmm. You talk about uncertainty if you do not know the outcome and you do not have any probabilities for possible outcomes. As an insurance investors, we act in insurance business as we do in the investment business. We have to have probabilities to develop a diversified portfolio, to calculate the risk-return profile. And that's the problem with emerging market investments and, sorry to say, especially investments in Africa. Mm-hmm. We do not have risk, we have uncertainty. And we have to reduce this uncertainty and transfer this uncertainty into risk. And how can we do this? And that was partially your question. Think about if you go for wind energy investment, green energy investment, feed-in tariffs. Feed-in tariffs can reduce the uncertainty because, for example, you can structure it that in 15 years you get your capital back without any return, but at least your capital back. And then we'll see how the energy price develops in the future, the carbon pricing develops in the future, and you might get a yield or not, but you don't lose money. Or if you take a first loss piece like with IFC or an African Development Bank or whatever, or at least a co-investment. So, for example, GE, just an idea. You know how to structure projects. If you put 10% of your own capital in the project, we give the 90% because we trust GE that you can do the right project work. You see, something like that, so that we can elaborate on a basis which reduces the uncertainty, transfer it to risk. There might be projects which do not work out. That's fine. That's in Europe the same, and in the US, etc. But we have to be able to calculate this.
Philippe, I'm going to give you the final word in terms of responding to the questions that have been raised.
I'm going to this billion to trillion, the standardization, the de-risking, trying to find new ways, new instruments, trying to work more with the World Bank, IMF and others to push private sector development through policies, regulations, try to increase the space. Right. And last point, because I think it's very powerful, we talk about billion to trillion and we think investors come in capital market are in the rich countries. But I think the long-term solution, but we have to start now, is also to continue to do the work that we have done over the years and maybe kind of put it more strongly on developing local capital markets, starting with the bonds. You know, I think it's hard, but we have to do it because in the end, I mean, this will be part of the solution. So again, I don't think there is one magic bullet. Yeah. There are many different bullets. We have to try them all.
So, ladies and gentlemen, we're about to wrap up the conversation, and we'll take a cue from Philippe, and I'm going to ask each of the panelists to give me a headline. If tomorrow you had the leeway of putting a headline on all the newspapers around the world based on this conversation, what would that headline be? I think we know what Philippe's headline is, IFC 3.0, and that is the headline. Andreas?
We know our corporate responsibility, and growth in developed markets is not possible anymore without growth in emerging markets. So we have to support emerging markets, but also you have to support us being able to invest with you.
Support us to support emerging markets. That's the headline. Emmanuel?
The headline for us is to leverage on the know-how, which is quite huge all around the world, to make it happen, and we will be successful because we have no other choice.
We will be successful because we don't have any other choice. That's a fantastic headline. Thomas?
There's so many ideas. I think capability, support in the countries that need to go from billions to trillions, and credit guarantees to backstop projects.
Credit guarantees to backstop projects. Teresa?
Okay, I'm going to go big time. Overnight, every government in the world now is aligned to actually work for the benefit of their people.
Oh, fantastic. Wow. Afsana?
And I'll just end up by saying doing well and doing good are going to be the same thing, which is what the SDGs are about. It's what we talked about.
Doing well and doing good, that is the last say from the panel. Thank you so much for making the time to join us. I'm Nozipho Mbanjwa, coming to you from Washington, D.C. at the IMF World Bank Group annual meetings. Until next time, it's goodbye. Thank you very much.